Lizanne, what are you telling your clients about what to expect from tomorrow's report and how that might influence Fed expectations and this summer rally we've had?
So I think one of the things that we learned from Friday's jobs report is that a significantly outsized print relative to what was expected could be a volatility needle mover. What's interesting about tomorrow's report is that headline inflation is actually supposed to come down relative to the prior month, but core is expected to go up. And I think we're now at that point where it's not just what Powell is looking for, a series of lower readings, but the drivers of headline versus the drivers of core. And given that the shelter components, the combination of owner's equivalent rent and rent of primary residence represents about 40% of core CPI, and they tend to be stickier when they move up. But I think the question near term is how much of an offset is that to what clearly is some downside associated with commodity prices.
So you've been pretty defensive, right, in your overall positioning and recommendations. Lizanne, has the summer rally changed anything for you?
So, yeah, we've had a definitive focus on quality areas of the market. We actually went to sector neutral many months ago, feeling like factor-based decisions made more sense than just trying to make a sector call or two. I will say that this rally in many ways has looked better from a breadth perspective, from an internals and technical perspective, leaving aside some of the low quality pockets that have not only also rallied, but have rallied to a significant degree. You guys have been touching on it, whether it's the meme stocks or negative earnings areas, heavily shorted stocks. And so to put my trader's hat on for a minute, we've been saying you want to sort of fade the rally down the quality spectrum. There are times where you want to go down the quality spectrum. That's where the leverage is to an economic upturn in that no earnings, weaker balance sheet part of the market. I don't think that's the part of the cycle we're in right now. So we've been saying lean into the quality areas for leadership, but you want to fade down the quality spectrum. And I think that's the best way to approach this somewhat unique move off the mid-June lows.
No, and I know quality, you don't want to go sector specific, but just thinking about the cyclicals here, this is the second day in a row we had a downgrade of earnings expectations from a major semiconductor. Yesterday, NVIDIA, today, Micron. I mean, that's a cyclical group. It's tied to the fate of the economy. So what does it make you think about when it comes to some of the cyclical parts of the market that have rebounded?
Well, again, I think if you're really down the quality spectrum, sometimes makes sense if the market is pricing in a significant inflection point back up in the economy, similar to what happened when we got the news, the positive vaccine news toward the end of 2020. That was when it made sense to go down the quality spectrum to what had been hurt most significantly, to where there was no earnings because the leverage on the upside was there. I think what traditional cyclicals are telling you in many cases, depending on what segment of the market they are they global or the domestic, is that we are in a weak economy, if not a weakening economy from here. And that is sort of additive to the message around be careful about moving into segments of the market that really do require a turn back up in the economy. I don't think Friday's Strong's job report is a reason to really take a significant cyclical approach under the belief that we are going to see a turn in the economy. We think weakness is going to continue to be the trend near term.